Hi, my name is Stephen Gibson. I am a co-owner of Ease Fit along with Eric Gonzalez and Emily Kelly. We were representing Industry 2, letter E, for the business strategy game of Management 4388, Web 01, Administrative Strategy and Policy. Our strategic vision for Ease Fit was to sell the best quality shoe at the lowest price possible. We were offering superior material with labor-friendly production and eco-conscious packaging. We opted to offer less models than the average competitor, but never dropped below 75 models. And we initiated the high quality differentiation strategy by offering an 8-star shoe in year 11, 1 star above the highest SQ rated competitor. We thought based on our quality ratings we could demand higher prices, but we quickly learned that these errors and adapted our strategy accordingly. We plan to adapt strategy based on yearly outcomes and adjust according to market results. And throughout the competition, we did reduce from an 8 to a 7-star shoe. For the strategic map, year 11, the market snapshot reveals that a tight cluster of teams, with our team E being the most differentiated. They're at the top at a high cost, high quality shoe. We initially overshot the wholesale market average price of $74.46 by $25.53. This strategy was not as effective as we originally planned. Price reductions were necessary to ensure a more competitive advantage. Teams A, C, and F captured the largest market shares with 15.1, 15.2, and 15.1 shares respectively as a result of their lower costs and higher number of models offered. Although these teams were recognized as the front runners, they lost their competitive advantage through the simulation. Most notably, these teams failed to stay ahead of the other teams and lost their lead in year 12s to teams B and D. For year 20, the strategic map of North America depicts teams B and D as the top competitors, offering high quality shoes at costs well below industry average. B came in at $56, D at $51, and the industry average was $58.17. They also each produced nearly 150 additional models of shoes than the average competitor. B had produced 350 pairs, D produced 340, and the average was 195 for the industry that year. Our team struggled to keep up with these two industry leaders due to their ability to keep costs low and produce a large variety of models offered. For our final round of decisions, we adapted our strategic efforts to align with the market demands and forecasted the necessary shipment amounts and which regions merited the private label pairs. North America, we captured 20.5% in the wholesale, and the largest private label market share in Europe, Africa at 55.2%. The industry leaders B and D were the strongest competitors for years 15 to 20. D was the front runner from the start and quickly took the first place position in year 12, holding firm through the end of the competition. After closer analysis of their competitive strategy, Team D had the same strategy we initially tried to implement, but they were simply more effective with that strategy. The strategic efforts to offer high quality products at low cost is the most successful approach, in my opinion.
Alrighty, my name's Emily. I am a part of Industry 2, Group E, the Ease Fit shoe line. I will be going over the net revenues, the SQ rating for the North American plant, as well as our return on equity for the Ease Fit shoe line. So let's go ahead and get started with net revenues. By definition, net revenues is gross sales minus cost of goods sold. So the higher your sales are, the lower your material costs and the cost of production for the shoe, the higher net revenues you're going to have. For us, I think this was a little bit of a problem in the beginning because we decided on such a high quality shoe, and right out the gate, I think that was a little bit more affected our production costs a little bit more than it should have. However, we finally got a hold of everything and peaked in year 19 with a total net revenue of $437,758,000, which was a nice 36% increase from year 18, where we reached a total of $322,210,000. So although it does fluctuate throughout this 10-year span, overall, long term, it does show a generally positive trend. I think that's something to note, and I think if we were to continue on with this game, we would have continued to grow in that fluctuating positive manner. Moving on to SQ ratings. SQ just stands for style and quality. For the Ease Fit shoe line, I believe our strategy from getting out the gate was a very high quality shoe, and having a price that could compete in the market with these lower quality shoes, but still being a little bit more expensive to kind of make up for those production costs that we were incurring for making this 8-star shoe. So from years 11 to 15, we had this 8-star, but it wasn't really working for our strategy and our group. So from years 16 through 20, we decided to lower that SQ rating to 7 stars and kind of hop back in the market and be a little bit more competitive. We hoped that it would not only make us more competitive, but also lower our production costs, which was a big expense of ours in the beginning of the game, which is why our net revenues were so low in the first few years. So overall, I think if we would have flipped the script and gone with a little bit lower quality, maybe a 6 or 7, but keeping in that very competitive price range with all the other companies, we would have had a different result in our game. I think a more positive result. So our SQ rating did fluctuate, but we tended to go backwards, other than unlike our competitors who moved from a low quality to high quality, we went from high to low. So that is our SQ rating. Our return on equity is next. Return on equity is just the amount of net income returned as a percentage of shareholders' equity. And it's a measure of profitability for a company based on the money it generates from their shareholders' investments into the company. And we can see here in year 14 was the only time we actually exceeded our investor expectations. I believe this was due to us increasing our production capacity and adjusting our exchange rate, how our exchange rates affected us. We were able to distribute places that didn't really take as hard of a hit into our costs with the exchange rates. So we tried to balance that out there. Although we did not meet expectations of investors through the majority of the game, I believe it is noteworthy to say that in years 12, 15, 19, and 20, we did have a return on equity that was above 10%. So I do believe that is shows a very positive growth, and I think it would have maintained this positive note throughout the years. We had such a low return on equity in a few years because we decided to build some capacity, and we decided to take and share, sell some of our shares. So I think that kind of affected our return on equity. And I believe Eric will be continuing the presentation.
Hi, my name is Eric Gonzalez, and I'm one of the co-owners here at EastFit. Today I'm going to go over with you about a couple of slides, beginning with stock price. Unfortunately, investors' expectations were only met in year 14 and fell short otherwise. Efforts were driven towards meeting all investors' expectation metrics, but were faced with stern competition, and a few poorly considered decisions were a result in our displayed stock prices per year. If you look at year 14, this was the year that we exceeded the investors' expectations, but not only us. All companies in our industry either hit or exceeded the investors' expectations in that year. Year 19 to year 20, our company got real close to hitting the investors' expectations. I believe this was due to our understanding of private label market. We didn't enter the private label market till the towards end of the game, which we also started taking a good portion of the market share there. If we would have had a couple more rounds, our company would have probably started to hit the investors' expectation they were requiring. For our strategic planning exercise, this spanned between years 16 to 18. For this exercise, we set a 3-year strategic plan. In those 3 years, we wanted to see a positive increase between our earning per share, return on equity, credit rating, image rating, and stock prices. If you look between year 16 to year 17, we did increase on everything besides our image rating. Our earning per share was $1.68 to $2.10. Our return on equity went from 7% to 8%. Our credit rating held a positive A plus between the 2 years. And our image rating unfortunately dropped from 65 to 64, and our stock prices increased from $19.13 to $24.69. Unfortunately, between year 17 and year 18, we did drop on everything besides our credit rating and our image rating. We went from earning per share of $2.10 to 71 cents. Our return on equity was 8% to 3%. Our credit rating, once again, was still A+, and our image rating was at 64. Our stock price did decrease from $24.69 to $14.12. For our group, we had no real consistent competitive strategy. Instead, we reacted to the market change and the change of our competitors, which made us lag behind in market shares throughout the competition. Our competition over the course of the business strategy game have changed their tactics over time. In the early rounds, we developed a similar strategic effort as Team D, identifying them as our primary rivals. The reason why we considered them our primary rivals was because they were going for a high quality shoe with a few models available. Over the years, Team B and D were in direct competition with each other, competing for low cost, large number of models available, and expensive advertising budgets, which propelled these teams to the top by the end of the decision rounds. For the majority of the game, Group D retained a large portion of market shares. For example, in year 12, their market snapshot reveals the impact of the decision of the industry competitors. In year 12, wholesale was 15.2%, internet was 22.2%, private label was 12.5%. The second graph illustrates Team D's transition throughout the competition, year 18, while retaining the control over the industry. Some lessons learned during the simulation revealed a lack of planning in the initial decision rounds. If we had the ability to start over, we would have initiated a more competitive pricing and waited to produce a higher quality shoe until later rounds. We would have also decided to begin building new plants early on in the rounds to receive the most out of our investments. We would have also entered private label market shares from the beginning and set a firm foundation to build from with the written 3 to 5 year plan. Looking forward, our adaptive strategy could have been improved with additional practice rounds to better understand the decision screens and the effects of each change. Overall, we learned that running a business takes a lot of investment and research into the markets and also paying close attention to our competitors. Thank you.